Hello Proponomics people, and welcome to day 17 of the Proponomics Advent Calendar for December 2023. So today I'm going to be talking about interest rates and their impact on the availability, demand, and also, most importantly, the price of housing. So of course, unless you've been hiding under a rock, you will know that in the UK in the past 2 years, we've seen a slow, steady and significant increase in interest rates after a long sustained period, nearly 13 years long, of rates being ultra low, hitting new lows all the time, base rate at 0.5%, then 0.25%, then 0.1%, and it really couldn't have got any lower unless it had gone negative. And what we've also seen is the bond yields. Remember, if you don't understand the bond yields as much, go back to check video number 1 and video number 2 in the Advent Calendar series. But we've also seen the bond yields decaying steadily downwards from around about 5% before the financial crash all the way down to 0% at some points in 2020 and early 2021 as things really collapsed and there was fairly significant panic during the course of the pandemic. But now they've come right back and they look once again like they did for some of the time between, say, 1999 and about 2007. So it looks like a normal market, although there's a significant change. And we can all see, of course, what impact that's had on the price of housing. So house prices have been relatively steady. They were predicted to go down significantly. They haven't, because apart from anything else, inflation, and particularly wage inflation, has played a huge part in holding the nominal price of houses upwards. But if you looked at house prices in terms of adjusted for inflation, you would see they've actually gone down significantly, over 10% in the past 12 to 15 months. So that's the effect that raising interest rates has had. Of course, not everything stays the same in the economy at one time, so we can't measure it exactly. But we do know that the number one driver for house prices over time is actually the availability of credit. Now, credit availability hasn't really come down too much. It's tightened slightly, but the rules under which owner-occupiers are scored for mortgages, the same rules that were set in 2012, and the stress test for the base rate back then was 5.5% for the pay rate on mortgages. And of course, we've reached 5.25. And whilst most people think we're not going any higher, we roughly sort of got to the stress case that was built in 2012. All the residential mortgage lending since then has been based on that stress test. So we haven't reached quite the ceiling of the stress test, but we're pretty much there. So you can show they did some great work, actually, the regulators back in 2012, coming back to what will happen when the housing market and when the interest rate, apart from anything else, returns to normal. So it's not the availability of the credit so much that's changed, but it is the price. So for interest-only mortgages, it's quite common for people to be facing around 80 to 90% higher bills in terms of their interest on their mortgage. For owner-occupiers, it doesn't quite appear as bad as all of that because the capital repayment element has remained fixed. And in fact, some people, by taking out their mortgages for longer terms, perhaps the bank's added 5 years to the term or similar, have actually been able to lower their capital repayment element whilst the interest payment has moved up so much if they're not on a fixed rate. But of course, so many people were on fixed rates and lots of people hurried to fix as they saw the rates were going up in 2022 as well, that there's been a relatively limited impact on the way that interest rates have changed. But you must remember that it's not the base rate of interest that particularly defines these things, defines the price of a mortgage, or certainly a fixed mortgage. Obviously, it defines the price if you've got a mortgage that's linked to the bank base rate. But it's not that defines it. It is the UK 5-year bond yields, if we're talking about a 5-year fixed rate mortgage. And that market has calmed down fairly significantly over the past couple of weeks, having reached some real highs earlier in this year. So as we stand today on the 17th of December, there's actually a good chance that some under 4% mortgages will be being released relatively soon for the owner-occupier market. And in fact, for the investor side of things, I would expect to see relatively quickly some 4.6%-ish mortgages for 5 years with a 5% fee, or perhaps some 5% mortgages with a 3% fee, or maybe even a 2% fee, if anyone really wants to win business. So it's really starting to normalise the cost of debt again, which is fantastic news for the market overall. And I think this will be a positive sign for what happens in 2024. But ultimately, we'll see what happens, and we will be there together, and I'll be continuing to record some video content alongside the Sunday supplement and the live specials in the new year. So thanks for listening to this one, and I'll see you again tomorrow.